The takeover regulation panel says it will provide guidance on the way forward after Canal Plus beefed up its stake in Multichoice to 35%. Reaching this level satisfies a threshold at which a mandatory offer must be made to shareholders. The watchdog has stated that it is talking to both parties to provide guidance and guidelines on how the matter is to be handled and addressed. Multichoice asked the panel to make a ruling about whether a mandatory offer must be made to all holders of ordinary shares in the company under Section 123 of the Companies Act. This follows the DStv owner's rejection of a buyout offer from Canal Plus. The French entertainment giant proposed an offer price of R105 per share. Multichoice says this significantly undervalues the group and its future prospects, but the door has been left open for further negotiations should Canal Plus choose to sweeten its offer price. DRDGold is expecting a profit bump. The tailings treatment specialist has forecast a rise in half-year headline earnings per share of between 5 and 15%. That's as higher cash operating costs dampen the group's achievement of 12% revenue growth. More detail will be provided when the company opens its books on the 14th of February. Mastercard will invest up to $200 million into MTN's fintech business. The transaction values the division at $5.2 billion on a cash and debt-free basis, which means the payments company is taking up a minority stake in the business of just under 4%. MTN says the relationship is a key enabler for the acceleration of its fintech business's payments and remittance services. The group added that it would continue to explore opportunities for other value-enhancing partnerships and investments with strategic partners and long-term investors. Lusaka has bought TouchSides from Heineken. TouchSides is a data analytics and merchant services company. It has an active base of over 10,000 point-of-sale terminals across South Africa's informal licensed taverns and processes more than 1.5 million transactions a day. Lusaka says the acquisition will complement its own Kazang business and allow it to expand its footprint in the tavern industry. The terms of the transaction have not been disclosed. The Competition Commission is pushing forward with its rand fixing case. It's approaching the Constitutional Court for leave to appeal the ruling that dismissed currency manipulation charges against the big 3 SA banks and 14 foreign banks. The Commission's case has been dismissed twice by the Competition Appeal Court. Last month, that court found that the Commission had failed to provide or prove that the 21 banks it charged had participated in a single overarching conspiracy as it had alleged to fix the rand exchange rate. But the Commission is determined to go forward with the charges. Further afield, BP posted forecast-beating earnings of $3 billion in the fourth quarter, while boosting share repurchases and vowing to make pragmatic investments as its recently appointed CEO sought to allay investor concern over its energy transition strategy. Here's more detail in this package report.
BP beat forecasts in the fourth quarter. The British energy giant posted earnings of $3 billion on Tuesday, beyond projections of $2.77 billion. BP said the results reflected strong gas trading and higher oil and gas prices. That offset negatives including lower refining margins and weak oil trading. BP also boosted share repurchases and vowed to make pragmatic investments in moves to soothe investor concern over its energy transition plans. Now the earnings are a relief for recently appointed CEO Murray Auchincloss. The company had missed forecasts by a wide margin over the previous 2 quarters. Auchincloss replaced former boss Bernard Looney, who suddenly stepped down last year over a scandal. The new CEO told Reuters BP was still committed to reducing oil and gas output. It also wants to grow renewables and low-carbon businesses by the end of the decade. But he said BP would pragmatically adapt to what's happening along with demand in society.
And Germany has outlined new plans to subsidize its energy transition from gas to a shift into hydrogen. Let's cross over to our reporter Ndawleng Lachela for further insight. Well, Zinati, the German government has presented its long-awaited plan to help the country cope with the country's energy crisis. I'm now joined by DW correspondent Chiponda Chimbelu, who has the on-the-ground insight. Thanks for joining us today. Now, let's get straight into it. Chiponda, just tell us more about this plan.
Thanks for having me. Well, the German government has been working on this plan for months, but coming to an agreement has been tough because the ruling coalition is made up of 3 parties, and they, of course, each have their own interests. This plan is a compromise, and it involves the construction of gas-fired power plants to help compensate for renewable energy, which is growing but fluctuates supply to the power grid. The new power plants will step in whenever the electricity generated from renewable sources isn't enough to cover demand. And the new power plants are supposed to be climate friendly in the future. The plan is for a switch from natural gas to hydrogen at a later date. The government estimates its plan will cost between 15 billion euros and 20 billion euros. Now, that is going to include subsidies that will support the construction of the power plants and funds set aside to offset additional costs of operating the plants with hydrogen.
And what has the response been like from the energy industry?
Well, industry in Germany has welcomed the plan, and that's also because the locations for the plants will be strategic to ensure that they can also benefit Germany's energy-intensive industry. Companies have been calling for new power plants to be built in areas where power production is below target levels, especially in the west and southwest of Germany. German utilities, including Uniper and RWE, have welcomed the news. They have been waiting for months for the government plan after expressing interest to participate in the construction of new gas-fired power plants. Grid operators are also positive. They see the plan about locating new plants in strategic areas as a good change.
Lastly, has there been any challenges, any pushback when it comes to government's plan?
Well, this plan could face some opposition from European authorities. EU authorities are critical of the specifications about the locations of the new power plants. They fear that they could reinforce existing imbalances in the grid expansion. But that's just, of course, not the only issue that this plan could face. Its critics also say that converting the new plants from running on natural gas power to hydrogen could be significantly more expensive. And environmental activists have pointed out that the 10 gigawatts that the government is planning may not be enough. They say it needs to produce more clean energy to be able to switch off the last coal power plant by 2030. And there's also been criticism from the German Chemical Industry Association. It says that the amount of that the government has set aside in its plan will not be enough to ensure energy security. But the government says it is certain that Germany will be able to turn off the last coal power plant in 2030.
Thanks for your time and those insights. That was Chiponda Chimbelu from Deutsche Welle.